Howdy. This is session 13 in our Craft Beer Finance series of podcasts. And this short session is a complex one, but an important one, especially when a craft brewer or any business owner is looking at making a major investment that will have benefits and costs over a really long length of time, say several years or more. We're going to primarily focus with an aspect of capital budgeting and specifically net present value and weighted average cost of capital. And with net present value, it'll help overcome some of the weaknesses that we saw with the payback method. The concept of net present value or future value really comes from what we call the time value of money. In other words, how the value of a currency, a value of a dollar, changes over time. A dollar 10 years out or 20 years out is going to be worth different than what it's worth today because of things like inflation and other factors we'll talk about. If you look at this very straightforward example, this is a future value example where we invest some money at a particular time, in this case $1,000, and it earns a level of interest on that original investment over time. And I believe in this case it's a 10% annual interest rate. As you can see as you go across, the principal, of course, the $1,000 stays the same, but as we earn interest, you can see in the brighter green, representing the interest on the original 100,000, grows over time. But then the item above that, the bar above that, in the darker green, is the interest on interest. So one of the key concepts of time value of money that we'll talk about or use today is the importance of compounding. Interest not only being earned on the principal, but interest also being earned on the interest. And we're going to assume that we keep that money in the investment and don't take any of it out over time. Now in this example, we're saying we're putting money in and then figuring out what's it worth at the end of 20 years. However, which is called the future value of money. What we're going to be very concerned with today is what we call the present value. In other words, if you were to go out to the 20th year and see that they have about a total accumulated $7,000 in money, we want to develop some mechanism to find out how much is that $7,000 worth in year zero. In other words, we want to see what's the present value of the year 20 $7,000 or any of those years outside of year zero. What we're talking about is a net present value, which is a process to determine the future value of any future cash flows, typically on an annual basis. And to calculate the present value, we're going to use something called a discount rate. In other words, what's the rate of return that the investment is guaranteeing, or that a minimum rate of return that our investors desire. At the end of all this, we're going to develop a decision rule that says net present value, after we calculate it for a particular investment or project, if it's zero or greater than zero, we should say that we accept the project, or at least it's financially acceptable from a financial basis. Or if it's negative, if the net present value comes out to negative, we should reject it. In next series and other podcasts, we'll get to examples of that, but just to remember, this is an important rule that we'll use throughout. A couple things to note about net present value. One is that we try to look at any project or investment on what we call a standalone or an incremental basis, meaning we only want to see those revenues, expenses, investments, and benefits and costs that are solely related to the investment itself. Not anything that we take and try to allocate from a different business or from a corporate headquarters or something that's not a specific cost or benefit or a direct cost or benefit to the project. Another couple of concepts we want to be aware of is one called sunk costs. So in other words, assume we're looking at buying a new piece of machinery. We're going to do it January 1, 2016. We expect to make payments for that over 3 years. We expect the life of it to be 7 years. We can calculate the costs and benefits. Any costs that were incurred before January 1st, 2016, like any market feasibility, any cost of testing, stuff like that, would be left out of our analysis. We're only looking at it as of the present going forward. A second thing that we want to be concerned with is a concept called opportunity costs. And in opportunity costs, what we're trying to get at is what's the alternative that we're giving up, or the existing thing that we're giving up to invest in this new product. For instance, in pharmaceutical days, a company had an antibiotic called erythromycin, which had been around for years, generated $300 to $400 million in sales every year and some good profits, about 30 to 40% gross margin. The company came out with a new antibiotic that was pretty much a replacement of erythromycin, but was going to have a general and some improvements, but was going to have a higher general gross margin of about 80 to 90%. So what the opportunity cost was okay, if we bring on this new product, which will cost a lot of money to invest, market, and so on, what is it we're also going to be leaving out? What are we also going to be losing through cannibalization of the existing erythromycin sales? We have to include those lost sales as part of our analysis. And also make sure that we include inflation, the third point. Inflation has not been as big a factor the past decade or so, but it is something we want to be concerned with, especially in some countries where you might have incredible inflation of 5, 10, 15%, which can really, really affect your decision-making process. The thing we want to focus on in this podcast is what we call the rate of return, or the discount rate that investors require. Important to know that any company will have different types of investors. It might be solely owned by the owner, privately owned. It might be financed primarily through bank lending or bonds. Maybe it's solely invested in by venture capitalists. Each of those different types of investors has a different requirement for rate of return, basically pretty much relying upon the risk that they have in your business. What's the risk they could lose their investment? In most organizations, especially big companies, publicly held companies, they use what we call a standard discount rate. In other words, for all their investment decisions, they use a standard benchmark rate of return to take any future cash flows and discount it to the present, bring it back to the present, and using a rate of return that they think their shareholders or bondholders or whatever investors will want on it. That discount rate we call the weighted average cost of capital, which is a combination of any debt or equity, the interest rate on that debt, and then also the return that our shareholders want. We add those two together, kind of blend them based upon the financing structure of the company to come up with an average, a WACC, a weighted average cost of capital, that will apply to all of our different people. Now, what about market interest rates? How do we come up with some estimate, or what drives market interest rates? Well, there's kind of a general formula for market interest rates, and this will be, of course, for bonds, bank loans, and such. Typically, market interest rates are composed of 5 or more components. First one is the RR, or what we call the real interest rate. In other words, there's going to be a minimum, once you strip out all components, all other variables, inflation, and so on, there's going to be a rate of return that investors need in order to even consider investing in your company. In this example, we're going to say 3%. Another component of an interest rate that's set by the market is going to be your inflation expectation. In this example, we're assuming 3%. Of course, in past years, it's been anywhere from 1 to 2%. A third component that goes into setting a market rate for an interest rate for a bond or for a bank loan is what's the default risk? In other words, what's the potential that the company could fail and not pay back their loan? In this example, we're saying it's adding 5% onto the interest rate. Next, we have what we call a liquidity premium, another component of bond or bank loan interest rates. What a liquidity premium is basically how easy is it for the lender or for the bondholder, how easy is it for them to get out of their investment? Can they easily go to a market and sell off their investment, or do they have to kind of ride the tide with the ship of the company and wait to get paid back? And then finally, loans have what we call a maturity premium. In other words, is it a loan that's only going to get paid back in 1 year, or maybe it'd be 10, 20, or 30 years? The longer time to pay back, the higher interest rate an investor will hold that will need in order to incentivize them to stay with to make the investment in the fact that their investment's going to be held for a long length of time. So if you added all these together in this example, you come up with a rate of return for debtors of 16%. Now, historically, in the past 5 or 10 years, this would be kind of high, but in years like this, decades like the 70s and even part of the 80s, this kind of rate of return or interest rate needed for bonds or bank loans was not totally unheard of. Now, what about people who invest who are shareholders? In other words, they want to own the capital, the equity capital, common stock, preferred stock, in a privately held company. How is that determined? Well, one of the key components that we have to look at in determining or estimating the rate of return they want on their investment is something called venture hubris. Well, what is venture hubris? Venture hubris is that investors take into account that the plans of management tend to have an overexuberance of optimism. So one of the ways they can offset that optimism is to increase the rate of return that they need on their investment. Many times what investors will do is they incorporate this investment or this interest rate or rate of return into the projections of the company. In other words, they'll develop a rate of return that not only includes what they would typically get if they were invested in a publicly held company, but they'll add in what we call an advisory premium, meaning they want to be compensated for, as a venture capitalist, for any business advice, financial advice they give. They will throw in that liquidity premium, that liquidity risk, in other words, another investment that they can't sell hardily. And then they add in, which is the HPP portion of the return on equity for private investors, the hubris projections premium. It's not unusual for especially venture capitalists to, when they make an investment in a very high risk startup, to look at making a return or looking at a minimal annual rate of return of 25, 35, even upwards of 75% per year. A huge portion of that return is in the hubris projections premium. So once you have the estimated debt interest rate, and you also have the equity, the rate of return by venture private equity investors, you can now develop a weighted average cost of capital. All it is the weighted average cost of the individual components of the interest-bearing debt and the common equity component. In other words, we take that rate that we estimated for the debt holders, the rate that we think the equity investors are going to want, and we're going to have to blend those or add them together. We'll do so on an after-tax basis. And what we'll do is, for the company, we'll take 1 minus the tax rate times whatever that debt rate, interest rate was we calculated. We'll multiply that result, the after-tax result, by the debt to total value ratio, which will be the total debt divided by debt plus equity. And we'll add that to the equity rate, also multiplied by 1 minus the debt to value ratio. Let's look at an example here real quick. Suppose a company has $1 of investment in it. Assume that 50 cents or 50% is debt and 50 cents or 50% is equity. Assume that the interest rate the company wants or estimates their bondholders will want is 10%, that the tax rate they've been paying for the company is 30%, and that their shareholders are going to want a 20% rate of return. What would the after-tax weighted average cost of capital be? Well, here's our formula again. Let's plug in all the numbers, and we come up with 13.5%. So in this example, the company is paying pretty much a lower rate of return after tax to the bondholders. So it may be more inclined, because because of the tax benefit and that the interest expense paid by the company is deducted for tax purposes, the company may be more inclined to finance with debt. Now, one thing to note that in this case, you're not going to finance the company with an unlimited amount of debt, because so assume the company went out and borrowed a bunch of money from bondholders or lending people from bank loans. Well, they take on additional too much debt, then the ability to repay that might be a problem, and you'll note that the default premium would go up, and thus typically the rate of interest would go up. So the final question we want to ask is, okay, we calculated a weighted average cost of capital of 13.5%. Is this necessarily the hurdle rate we should use for every different type of investment or project within a company? Technically, the answer is no, because that composite is an average. And when we take an average, if we were to apply it to every single investment, we would assume that every single investment has the same level of risk and the same type of investors. So what we really need to do is on each different investment is evaluate how the risk or the potential for losing money in that investment or not getting the benefits from it is in relation to the average, and then adjust the weighted average cost of capital accordingly.